In this video, I want to consider how small, mid, and large cap stocks react to economic cycles. The economy moves in cycles. It has different phases, and so how do these different market cap stocks react to different phases of the economy? Number one is small cap stocks. So small cap stocks actually are sensitive to economic changes. They are sensitive to economic changes. So small cap stocks are more vulnerable to economic cycles due to limited resources and less financial stability. They are vulnerable because when it comes to that financial strength, these stocks are a bit lacking in that regards. And so they may struggle during recessions or downturns, when access to capital becomes more challenging and, consumers are no longer really have the desire to spend as they used to when consumer demand weakens. So they are prone to kind of going on a kind of downturn when exposed to this kind of economic condition. There is higher volatility. In periods of economic expansion, small cap stocks tend to outperform as they have greater growth potential. They have the growth potential, although at a higher risk anyway. However, during economic slowdown, they may experience significant volatility and losses due to their dependence on external funding and market sentiments. When they can no longer get funding as expected, that will affect their operation, and we discover that it will affect the company concerned negatively. Number two is mid-cap stocks. For mid-cap stocks, there is that moderate sensitivity. This moderate sensitivity. Mid-cap stocks are more resilient than small-cap stocks, but still are sensitive to economic shift. They're not as pronounced as what's obtainable with small-cap stocks. They often benefit from having a more established market position, though they are still rely on growth to expand further. So when it comes to balanced performance, during an economic recovery, mid-cap stocks may perform well as they capitalize on both growth opportunities without the high volatility of small caps. They are not as volatile as small caps, and they equally have growth opportunities, so they tend to recover quickly. And not only that, in downturns, they tend to outperform small caps, but may underperform large caps due to their limited financial strength. They perform better than small caps, during economic downturns. They do that. They underperform, small cap. They outperform small cap stocks, but they underperform large cap stocks. They are just like, in the middle. Number three is large cap stocks. When it comes to large cap stocks, we're talking about stable, there's that stability during economic downturn. They have stability during economic downturn. So large cap stocks, being more established and financially secure, are generally more resilient during economic recessions. They are secure. They have better balance sheet strength, and so they are more resilient during you know a phase of economic recession. Their strong balance sheets, diversified revenue streams, and ability to access the capital markets allows them to weather the downturn better. They can weather the downturn better because of access to capital, you know, diversified revenue and income stream, and a stronger fortress balance sheet. Then there is that there is that slower growth in expansion, slower growth in expansion. So while large caps are less volatile, their growth potential is limited compared to smaller companies. It's like two ocean going vessel. One is a smaller yacht, another one is an oil tanker. The same condition, the same rough sea, but the yacht will go faster than an oil tanker. So large cap stocks are like oil tankers, crude oil tankers, while smaller cap stocks, smaller companies are like yachts or flying boats. They move faster, during economic recovery. That is what we need to consider when it comes to investments as it relates to how these different market cap stocks react to economic cycles. So, I want to look at the summary of economic cycles' impact on these stocks. So during a typical recession, small cap stocks suffer the most due to their higher risk and lower access to capital. Mid cap performs moderately, while large cap offers stability. So during recovery and expansion phase, small cap and mid cap generally outperform large caps as they benefit more from economic growth and expanding market opportunities. And then when it comes to the phase of stability and decline, discover that large cap stocks provide they provide safety. They are like safer, and they equally provide steady returns, while small cap experience more volatility. So mid-cap balance risk and reward, adapting to both growth and the contraction phase. So you discover that a mid-cap, they are ideal kind of, it's an ideal investment at this phase of the economy. So understanding how economic cycles, affect market cap categories help investments. They help investors align their portfolio with the prevailing economic conditions. You need to know precisely how these different classes, different categories of stocks react to the economy. That will help you as regards to how you would include these stocks in your portfolio.